Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I play an economist on TV. I am joined by the one, the only trader extraordinaire, my favorite person in the whole world, the one and only Anthony Esposito. Anthony, how are you? How's your week been?
The week, I'm good, winning at life. The week has been fantastic. There's been a lot of chaotic market action, headline bombs, economic releases, earnings releases. We're almost done with the S&P now. It's been crazy, but it's been good. The report in the morning has been very accurate. I actually called almost the market top. I was a day off of the all-time high. Backed away from what was a positive signal in the model because of other indicators that I saw, and wrote that it was time to be, as I've been saying since early December, defensive and cautious and kind of selling into these rallies. So since then, we've sold off about 5% in 6 days, which has been a tremendous move. The VIX on a trough to peak spike was up about 46%. And the two things I had been saying in the note over the past week in particular was, 2 weeks in particular, was buy vol and sell the S&P. And that was the double-sided trade. So that's kind of where I've been sitting at Island Capital. It's been a very good month. We're actually up. We're up about 7% this month versus the S&P, which is, I guess, down about 3% or 2% now, maybe a little more. And I wanted to break it all down into one, start with profits this week and break it down into one simpler chart. I've been talking a lot, and take the headlines out of it, take Ukraine out of it, take inflation out of it, take NVIDIA out of it. I don't care about DeepSeek. I don't care about anything. And the reason I say that is everything that we've taken in, processed, becomes a price point. Where did they get bought? Where did they get sold? And that becomes the chart. You can't change that. You can't go back and adjust earnings. You can't go back and change your forward numbers. You can't change or erase your signature on a piece deal. Nothing on this chart will change. This is all concrete, frozen in time. This is where they traded. And I've been saying since December, heading into January, that I thought we were now topping and not consolidating to continue higher. So all along, this chart goes back to March of 24, but all along the way, we've kind of seen consolidation and move higher, consolidation and move higher in a greater uptrend, which has been fine. What we're seeing now is, and I've kind of blocked off, this is front month futures on the S&P. So if the prices don't match what people see on the S&P 500 cash, that's fine. But this is the futures contracts, the generic front month futures. I've blocked off what you can look at and say, this is now becoming a horizontal pattern and not a vertical pattern, right? So if we're going lower left to upper right, we've been in that nice, and this is a very simple way of looking at it, but it is how I'm looking at it in one way. We were going lower left, upper right, upward trend over time, very pretty. We've had some movement within, some consolidation and some retracement, but overall, lower left to upper right. Now what you've seen in this red box, this consolidation, is we're starting to move left to right. For me, after two 20+% years with daily momentum very volatile, weekly momentum, monthly momentum, and model signals showing weakness, degradation, or shifts to negative outright, this is looking more and more like a topping pattern to me. And I believe it is. So the top of this pattern at 6180-ish, the bottom of the pattern at 5805, that's about 380 points. In a very basic measured move way, what I'm saying here is we are topping. The music is coming to a stop. We're in the recognition phase of a bear market. In that theory, three basic phases. We would have recognition at the top. We would have fear on the way down. So recognizing the music is ending, fear that you're going to lose your profits and money that it's taken you years to achieve and accumulate on this trend up. And then capitulation at the bottom, where at the end, everything's getting sold at ridiculous levels. Valuations come into, whether they be cheap or fair levels, they're there. And that's when you want to be in buying. You're never going to time it perfectly, but those are the three phases I'm referencing. So recognition here in the big red box, a break of 5,800 on the index is going to create a measured move down of 380 points. So you have a 380 point consolidation, which is becoming a 4-month consolidation. We're starting to get into an intermediate term, a longer term consolidation. 380 points down will bring you down to about 5,400 on the S&P, front month futures. You can do this on a percentage basis and get the same move down in the SPX cash. But the point being, we're pretty close in numbers here as far as front months at this point to cash, as they are the March contracts, and we're getting into March. But we're looking at a move down, a measured move down to 5,400 on a break of 5,800. This is the cleanest way that I can think to present it and not go into all of the rabbit holes that there are about the why, the what's, and momentum and trend and term structure of the VIX and spot VIX. Like, there's a lot to go into here. Simplest way to look at it is we are consolidating, we are topping, in my opinion. If we break 5,800 on these contracts, we are going to work our way down to 5,400. Will it be a straight line down? No, it may not be. We've had a ridiculous, 5% sell off in 6 days. We'll consolidate within this box. This box may extend out to the right a bit and get a little longer, which actually would help with the theory. If it does more work here in topping, we'll actually add more supply for the way down. But on the break of 5,800, which I fully expect, we are going to 5,400. That's happening. It's just a matter of being patient and being strategic within that move. This is kind of the overall eliminate all the noise. This is where we are. Now, last week, remember, we talked about, and we were at the top, at the all-time high last week. We ran a Fibonacci retracement from the 2022 lows through those highs. We ran extensions up. We ran retracement levels down. And we kind of showed that we were there. And we showed downside targets. And this is playing in line with that. But that conversation last week was actually very timely because we basically hit the top when we were talking about that and ran that regression. And that episode is up to look back at it. But kind of where we're at, this is the simplest way to look at it.
One of the things that amazes me too with a lot of this work that you do in markets and your different models that you use, right? The motor momentum trend model that you have is how the model will tell you essentially, right? All right, up or down. And then it's amazing how it's as if the market looks for news to fulfill that theory, or you know what I mean? Like it really is amazing how frequently you look at the market and you say, wow, why did the market make such a big move today based on what is seemingly relatively inconsequential news, at least relative to the magnitude of the move that the market makes, right?
Yeah.
And it really is amazing. It's as if the move up or down was already baked into the cake.
Yep.
And market participants were just looking for an excuse to buy or looking for an excuse to sell. I mean, it genuinely is amazing how, again, the market gets overbought or oversold. Yep. And it's as if people somehow fundamentally recognize that and they just need an impetus to move. And knowing that people are looking for an excuse, again, to either buy or sell. Yeah. Right. It's as if that's what's going on here. What's kind of at work with the models. It's just really amazing. The work that you do and what you've really put together here, Anthony.
Thank you. And honestly, EJ, that's a great way to talk it out and talk it through. A lot of times what I say is and I've been saying this for a long time. I think I stole it from John Hussman, who, I mean, years ago, 20 years ago, was a advisor that I followed and ran a kind of a bearish tilted fund. But I personally love to hate them, and I admit that. So that's kind of why I was a Hussman fan. But he used to say that the headlines are interchangeable. I believe it was him. Maybe I made it. You know what? I'm going to take credit for it. Forget Hussman. Forget I mentioned that. I'm making that up.
We can edit this out in post.
The headlines are interchangeable. A lot of times, and Anthony, a great
that's
example.
A great line. How'd you come up with that?
Yeah, no, I just thought of it just now. I don't know. The December 18th sell-off, and December, I'm happy to say, was our best month ever at Island Capital. The performance in December was actually so good. I'm not going to say it because it sounds fake, and I'll feel dumb saying it, but it was phenomenal. That December 18th sell-off was triggered by Powell comment, shocker, which was not new at all. There was nothing unexpected about what he
Right.
said that day.
Mm-hmm.
Zero. But the market reacted with a 2.5% sell. I mean, it was a ridiculous, disgusting black bar down coming out of that announcement. So
Yeah.
it's kind of like, well, why did the market react to something so aggressively when the data point was what was expected? And why did motor, momentum, and trend indicators and what I look at have me short? Well, I'm not really sure why the market waited to react, but I can tell you that under the surface of price, so you have price, and then you have all the underlying strength. Under that surface, the internals of the market, I was definitely picking up on a weakness. I was definitely picking up on guys stepping away from that top price, that top card. And all they needed was a little flick from Powell to say there's nothing better here, and everybody was out. So, and I don't mean the long onlys. I don't mean Dreyfus and Fidelity and Fisher were coming in and crushing the desks and selling stock. That's not what I'm talking about. What I'm talking about is redemptions from retail money out, faster prop traders out, the commodity guys out, the futures, the CTAs out. All of that creates a ton of momentum down, in addition to derivatives trade that create supply in equities and cash markets because of those derivative trades. They're creating supply and coming out, and you get that big flush out. So headlines are interchangeable. And that's why I started talking about this chart by saying, I don't care about Ukraine. I just don't. I don't care about eggs. I don't care about you in this sense about eggs, Ukraine, the debt, the deficit, inflation, the 10-year. Like, I mean, I can connect the 10-year to what I look at for the equities markets, but in general, the headlines don't matter. They're interchangeable. And on any given day, on a big move up, a big move down, you can blame that headline, you can credit that headline. But at the end of the day, the market was telling you for the most part where it was going to go. You just have to be able and willing and capable of seeing it and listening. That other chart we had up, EJ, was the chart I was referencing, which was really, really spot on. If we can pull that up again, that was actually a Fibonacci retracement from the 22 low to the 24 peak. And then we had that move down in 24 and then the rally up, right?
Okay.
So I'm sorry, that was the COVID low to the 22 peak. And then we had some consolidation down, 50% retracement. And then I marked a measured move up, which overlapped exactly with 150% extension. So all that means is there were a lot of reasons why I felt that was longer term resistance. I wrote it in my note at the time, real time. This is not looking back and making believe I'm smarter than I am. I'm as smart as I am. I'll take that for whatever it's worth. That level was a real level. And what's really interesting is even though the S&P cash made incremental highs there, I still stuck to my guns and said this is not going to last. The futures did not make incremental highs. The futures, which trade 23 hours a day and are very levered, very, very liquid, extremely liquid markets, they didn't make new highs. We were at what I saw as a long-term resistance level based on extensions, based on measured moves, the same types of things we're looking at here, and we're failing there. And I think that was the top for now. That is the top of this consolidation, and we have a lot of room to go. So awesome chart there. We move on to economics a little bit, and we've had some inflation numbers come out. I just want to get your quick take on them. We had the PCE core numbers come out. We've had personal consumption numbers come out. Inflation numbers look like they are as you expect, right? They're a little hot, and they're not coming in. They're a little stickier than what Powell had been talking about when he started cutting with the 50 basis point cut in September.
Exactly. And not only are the numbers that we're getting for the most recent months not looking that good, right? They're still too high. The inflation numbers are sticky, like you're saying, but we keep seeing previous months revised up. So we just got personal consumption expenditure price index data, and sure enough, not only was January pretty hot, December was worse than previously estimated. So and same thing when we look at the consumer price index CPI. So it doesn't matter if it's PCE, CPI, or one of the other indexes as well. We keep seeing the same thing. The numbers are still coming in much too hot, and in fact, in recent months, again, we're seeing a reacceleration of those inflation rates. So it's absolutely the case. As we talked about back in September, the Fed had no business cutting
Yeah.
rates. It was going to put inflation back on the roller coaster, and here we are, several months later. Sure enough.
Do you think so? Let's take a second back because we've both been very critical of, and there's been more criticism raised as we came through the election, and more level-headed, objective, intelligent people have taken seats on Capitol Hill and in the arena. Very critical that Powell was politically motivated with the 50 basis point cut. We said it at the time. I think him and Yellen are absolute hacks. Do you see, as a data-dependent Fed chair, can you come up with any reason why he should have cut 50 basis points back in September and then had two subsequent 25 basis point cuts only to get to this point? Was there anything, if we're gonna counter argue ourselves, are we being fair that saying that was absolutely ridiculous and he should step down, or was there something he could have been looking at that you see?
The only thing I can think of, Anthony, this is God's honest truth. The only thing I can think of he was looking at was the banking sector, the massive amount of unrealized losses. We're talking hundreds of billions of dollars in unrealized losses on these banks' balance sheets. And
Okay.
one of the really troubling things is that if we look at, okay, who has all of these losses? Yes, it is pretty widespread. That's true, right? No one was left untouched by the fact that literally the only treasury bonds, and not just bonds, but bills and notes, right? So the only US treasuries that were available for a very long period of time were essentially 0% interest. There was no yield on them. So since a lot of financial institutions have to keep a certain amount of those things on hand because of to meet different regulatory requirements, they were forced to load up on these things that ultimately were going to become losers. There's just no way around that. So everybody was impacted. It's just a question of who's impacted more or less than others. I mean, you look at a Bank of America, they hold a huge portion of these things. A large amount of their balance sheet has these unrealized losses attached to it. And yes, I understand it's an unrealized loss. So technically it's still a positive income stream, right?
Yeah.
Okay, that's true, except that the income coming in is less than inflation. So that's problematic, right? Because their costs are continuing to go up and their revenue stream is relative to that is dropping. So that's problematic. But the bigger problem is that a lot of these securities, they don't get to hold till maturity. They do get sold ultimately. Some of these, just to illustrate, let's take it to the extreme. When a bank makes a loan to you for a home, right? They give you a 30-year fixed rate mortgage. Sometimes the bank only keeps that on the books literally a month or two, and then it's sold. It's out the door, and it'll ultimately get traded around and then repackaged into a security, right? And that's where we get MBS from, mortgage-backed securities. But the point is that it's not common for a bank to make a loan and then keep it on the books for literally the entire life of the loan. Sometimes with shorter term stuff, that's the case, but it's very frequently the case that, again, those loans get repackaged and sold, at least for non-revolving debt. Revolving debt, I understand that's a different ball of wax, but that's usually not an issue with unrealized losses because revolving debt almost always, I mean, it's insanely rare that you find revolving debt that doesn't have an interest rate, which frequently adjusts to the changes in the market. Think of credit cards, right? You have a credit card, you flip it over to the back, and it's like, oh, here's the bank that issued it, right? Here's, whether it's, I don't know, Chase, right? You have a Chase credit card. Okay, Chase is constantly changing your monthly interest rate based on what market rates are doing. So as market rates go up, they're going to jack up your interest rate. As market rates go down, they're going to jack up your. Oh wait, I'm sorry. They'll lower your interest rate, right? So, but you take the point, right? So you don't usually have unrealized losses on that type of debt. Okay, so again, where are all these unrealized losses? They're pretty heavily concentrated, unfortunately, among small banks. Now, again, you do have some big banks like Bank of America that has a ton of these unrealized losses, but the same banks that got into trouble in March of 2023, I think it was, with Silicon Valley Bank. They went under. Several others went under. First Republic, I believe, was one of them. There's still a lot of problems among small banks, even among the regional banks, some of which are technically fall into the large bank category, large commercial banks. But again, if you're looking at it from the standpoint of, okay, the Fed is in charge not only of inflation, not only of full employment, whatever the heck that means,
Hmm.
but they're also overseeing the banking sector, and they're trying to prevent what they caused with Silicon Valley Bank. They're trying to
Hmm.
prevent that from rearing its ugly head again. So this is a very long-winded answer to your question of, is it possible a supposedly data dependent Fed found something that said, uh-oh, we need to cut rates? That is literally the only thing I can think of, that they were looking at
Okay.
more and more banks about to go to the wall. And they said, okay, we have to get rates down. And sure enough, when we look at the unrealized losses at these banks, both in terms of securities that are available for sale, and then also securities that have to be held on the books. In both of those instances, we see a big drop in terms of the unrealized losses going into the fourth quarter of last year. So it definitely did have an effect
Hmm.
on that front. And unfortunately, though, looking at this quarter, given how much yields have increased after they made those interest rate cuts, basically the 10-year goes up, what,
Hmm.
100 basis points in the
Yeah.
same time that the Fed cuts its interest rate 100 basis points. So going forward, I don't think it's going to have the same kind of salvific effect it had the first go around in those first 3 months. But that is literally the only thing I can think of. And outside of that, it just had to have been playing politics.
Okay. All right. So let's assume that he wasn't playing politics just for fun, which is not the case, but he still was dishonest in not opening up the real reason for the cut. Either way,
Right,
if the only thing
right.
that you can find is that would be to help the banks with their unrealized losses, he's still not saying what he should be saying, and he still put us in a position where we were more at risk for a spike in inflation or an uptick in inflation, which is where we sit. Interesting point on that, and that explanation is honestly, as usual, perfect. Um, Buffett is now over 50% in cash at Berkshire, being rewarded for that as the stock has hit an all-time high this week coming out of his investor newsletter. And two of the big positions that he's liquidated are definitely Bank of America and Citigroup. And I
Hmm.
believe Citigroup, I think he's almost down to 10% of what the original holding was. Bank of America, I think he cut it in half. Don't quote me on either one of those, but really reducing his exposure to those two financials in particular. And those were two of the big sales he had.
Right.
Um,
Right. Now, Anthony, if I can interrupt you real quick, I would love to get your interpretation there on what that means, because you're looking at a time when inflation is still pretty high, right? It's well above that 2% target.
yep.
Inflation expectations, and I don't care if you're talking about just
Yep.
the surveys of businesses or the surveys of consumers, or if you're looking at things like the break even rate, whatever the case may be, right? Any way you slice it, if you're looking at inflation expectations, again, by any measure,
Mhm.
they're still high. So the fact that somebody is willing to go to cash when
Yeah.
that cash is actively losing value, right? What does that tell you about? Well, I guess I'm just going to end it there. What does that tell you, right? How do we interpret an investor like Buffett saying, even though my cash is losing value right now, that's where I want to be?
So there's a couple of ways to look at it, and I'll be objective. The first one is he's 185 years old, so he might be. He's actually the 365-year-old that's claiming Social Security or whatever
Yeah,
the
he's
number
the
is.
only legitimate one.
I mean, he's 95, 96 years old. He's going to retire. He's going to hand the company over, or control of the company over, from an investment strategy standpoint. It is, it is a thought, and it is possible that they're trying to liquidate positions because of the fact that they want that new regime to come in and have some dry powder. I think 55% is excessive if that's your story, but I can have the conversation about that possibly being the story. Um, the other thing is, it is possible that there's a bigger deal in the works where they're raising cash, or have been raising cash for the past few years, in order to put a bigger deal together or multiple deals together. That's also possible. That kind of doesn't fly with me, because it's been a very slow grind through for the past few years, and
Hmm.
that pace has upticked in 24. So I find it hard to believe that he's raising cash and selling assets that he thinks are still well valued, or he has a good position in order to do something different. That's kind of not the way you manage a portfolio, and I would expect that's not the way he manages his portfolio. Um, And the last option is he is a value investor. The market is way over its skis, and he's looking at, the fact that he has some of these investments have run their course. And because the market is so far over its skis and is so overvalued across the board, that it's a large portion of the investments he holds, and he's cut over 50% of it to cash. It is better. That's a hard stop. Now, it's better to be in cash and have the optionality of cash and take in 4% on that cash. So remember, your risk-free rate now is as we've spoken about, way beyond what it was, 50 bips 3 years ago, and now 4.2% now. So if you're losing, let's just say you're losing 4% on the cash in real terms. That's much better than losing 30 or 40% on that investment if you see a real reason to not be invested in the market and you see real downside. So between the optionality of the cash, essentially think of it this way. In that scenario, I will pay you 4% on my capital for two things: for optionality and for the protection against a 20 to 30% drop in asset value. Okay, that's a trade. I'll take that trade and I'll move on because I think I'm right. So I'll give you the 4%. You're essentially giving me 30% in optionality. That's the way I would look at it as a PM and as a trader. And I believe that's the way they're looking at it through, my interpretation at Berkshire and with Warren Buffett's doing. I think it's anecdotal, but it is really telling that he is over 50% in cash at this point. And I do believe that's why. I just think we're way overvalued. He's had a great run, and I think he's just really been lightening up into the selling rather than, as he should, as a good value investor and trader and PM would, rather than selling when the panic starts. Start selling as people are still coming into the party. That's when people want to pay you more for the ticket, sell the ticket. And I think that's what he's done.
So now, does his firm actively short the market or no? In other words, if they anticipate the market's going down, is their option, okay, let's short it, or do they simply go into cash? Like, I honestly have no idea how aggressive they are.
No, I don't believe
Again,
he
do they short
functions
or no?
in that way like a traditional hedge fund would. I don't believe Berkshire actually holds short positions, so they don't try and get to a market neutral position where they have longs and shorts, and they're trying to be long the better names and short the weaker names, and they're market neutral, but trying to essentially make money in both directions, at least on a relative basis. I don't think that's what they're doing. I am sure that they have hedging strategies at Berkshire. I don't know for sure, but I would say no, they're not taking outright short positions in equities or in the markets. I think they're think of them more as a value long only shop.
Okay. So then, I mean, in that case, anytime they do go into cash, I guess we always have to entertain that possibility that is their version of a short position.
Yeah, you could look at it that way for sure. And then the flip side for Warren Buffett is he can wait for the entire economy to crash and then the government to come and give him a golden ticket and the best trade of a lifetime, and then he can be touted as a real patriot and philanthropist, even though he was guaranteed 6% with upside on every penny he put in. But I'm just saying that could potentially, not that happened in 2008. I'm just saying it could potentially happen.
Right.
And
right.
and we
Well,
should
it's like
definitely.
I'm going to probably butcher his last name, but Robert Kiyosaki.
Mhm.
He was the one who wrote the Rich Dad Poor Dad book, and
Yes.
he's written other
Yeah.
works too. Huge believer in real estate, in gold and silver and Bitcoin. I mean, a few other things too.
Yeah.
Basically, I think his shtick, and I think he's right. You probably agree with him too, that he likes to invest in things that the government can't print. Right.
Mhm.
He likes to invest in hard assets. I think I heard in an interview one time he was talking about how he invested in bulls. Like he actually owns bulls for breeding cattle.
Okay.
And one of the things he said is, look, the government can't like create one of these things out of thin air.
Yeah.
This is a hard asset. It's a revenue generating stream, kind of like real estate, et cetera. But in an interview, he was talking about how following the real estate crash and the global financial crisis, we're in the Great Recession and everything. And he said the government essentially subsidized me to take on tons and tons of debt to
Yeah.
buy up all this bad real estate, quote unquote.
Yeah.
And he brags about the fact that he is a billionaire in that he is $1 billion in debt
Yeah.
right now.
Yeah.
It's just it's absolutely fascinating to me how in those times of panic, right? There, you do get the government stepping in, unfortunately,
Yep.
on the policy side and making those policy mistakes where they rescue so many bad actors. I'm not saying Robert is one of those bad actors. That's not
Yeah.
what I mean at all, right?
Yeah. Yeah.
He obviously had the liquidity and I would say the available credit. Let's put it
Yeah.
that way, to be able to take on all that additional debt. But yeah, you do get plenty of bad actors who cause these problems, and then unfortunately, we have that whole too big to fail mantra, right? And again, maybe this was the interest rate decision. The Fed looks at Bank of America and says, "Uh-oh, can't let that sucker go under. So we're going to effectively bail them out at the expense of everyone else."
Yeah. Yeah. And I tease about Warren Buffett. I think my big sticking point with Warren Buffett is I don't like somebody who's worth billions of dollars telling people that make $250,000 a year that they should pay more in taxes. I don't think that he has any concept of what it is to make 250, 150, or 50. So I think his input on taxes for me has been a little bit of a sticking point, but that's another story.
Well, I can't stand the fact, and he knows better. So I have to believe this is not coming from a good place. I don't ever like to assign motives to people because, look, we don't know what goes on in somebody's head and in somebody's heart. But you have to, you can't tell me he doesn't understand the difference between a personal income tax rate and the capital gains tax rate. So he goes up to a microphone and starts blabbing about how, I pay a lower tax rate than my secretary, when he knows full well that it's because his income is not classified the same way as her income. And it'd be one thing if he said, look, capital gains should be taxed as regular income, but that's not what he says. He says, let's increase marginal income tax rates, knowing that won't address the problem that he just articulated.
Yeah.
I'm sorry, you can't tell me that's him being honest there.
No, they're political talking points. I like people that do what they do and do it, sincerely and without alternative motives and kind of that side talk. So,
as I wrote about it in Fake, gold is God's money. The government money is fiat currency, the dollar, the yen, the euro, and then now we have people's money called crypto. So the Fed is under a lot of pressure because they're the real fakes. The Fed has destroyed the monetary system of the world along with its central banks. It has manipulated the market. In my opinion, they went criminal once they started just pumping, working for basically Wall Street.
Yeah.
So when I watch Wall Street, I watch the price of stocks and I watch what the Fed is doing, I just get nauseous. I just buy more gold.
That's a great hit from him. Actually, gold, we've had some great calls in gold here. And I mentioned last week, and then I want to go on to the gold card. I mentioned last week that we had exited the gold position more strategically than that we didn't believe that there was upside, but the move had just become just hyperbolic. And as the underlyings were not matching up with the story or the price, it had just gotten too far. So not unfortunately, but maybe coincidentally, maybe I picked up on something again in the gold market. Hopefully I did, to be out of gold. I did not short gold. I was talking to another trader about this yesterday. He said he was thinking about getting short gold contracts. I wouldn't do that just because I'm waiting for this story to fully play out. But I did see some underlying weakness in gold as it got up through 2,900. It was a fantastic trade. I did talk about it last week about the fact that we were flat here and just waiting to re-enter. Did not get short. Would have been a great short. Did not get short, but kind of waiting for a better entry point now. But that run has been fantastic. I think there's still upside, but just on a kind of a strategic trade, I wanted to be out of what we were in because we had really, I consider it a core position, but I also have gray matter between my ears, and it made sense to kind of take to the side for a second. The gold card, 5 million, you get a ticket in. Let's see what the man's got to say about it.
It's sort of a green card plus, and it's a path to citizenship. We're going to call it the gold card, and I think it's going to be very treasured. I think it's going to do very well, and we're going to start selling hopefully in about 2 weeks. Now, just so you understand, if we sell 1 million, right, 1 million, that's $5 trillion, $5 trillion. If we sell 10 million, which is possible, 10 million highly productive people coming in, or people that we're going to make productive, they'll be young but they're talented, like a talented athlete. That's $50 trillion. That means our debt is totally paid off, and we have $15 trillion above that. And now I don't know that we're going to sell that many. Maybe we won't sell many at all, but I think we're going to sell a lot, because I think there really is a thirst. No other country can do this, because people don't want to go to other countries. They want to come here. Everybody wants to come here.
I love the bang. All right, so now Howard, by the way, I'm Hegseth, during that clip, and I love him, Hegseth is sitting there, and the look on his face, he looked like he was actually trying to do the math as Trump is talking through the numbers. And I love him. Believe me, I am very happy with him, where he's at, and the job he's doing. Trust me, respect the man fully. However, the look on his face as I was watching that happen live, I'm thinking to myself, is he trying to figure out the next move on the defense front, or is he doing the math? Anyway, so now Lutnick, let's listen to Lutnick, and then I really want your opinion on, does this work? Does it make sense? And kind of, are we heading down the right path?
Are they going to be vetted, first of all?
Of course. Deeply vetted, and we said that from the first minute go. These are vetted people. These are going to be great global citizens who are going to bring entrepreneurial spirit, capacity, and growth to America. If one of them comes in, think of the jobs they're going to bring with them, the businesses they're going to bring with them, and they're going to pay American taxes as well. So this is huge money for America.
And how many people are waiting in this line currently?
So there are 250,000 people waiting in line now. If they're willing to pay the $5 million, that's over $1 trillion. That comes directly to $1.25 trillion just for that line. And I think these people are going to come enormous ways, because they know they can come into America and they can be in the greatest country on earth.
So what do you think? Does this work? Is there a good angle here, or is this kind of like I'm sure it wasn't a whim. I'm sure they thought it through. What do you think?
Yeah. Well, Anthony, it's a great question. There's a couple of things to consider. One is you do have countries who do similar things to this. Dubai is one example, right? And it's been wildly successful for them. Now, Dubai is a little different in that it's basically just like a giant resort country, I guess, in the middle of in the middle of the Middle East. But whatever the case, yeah, people will pay to come here to the United States, absolutely. And the reason being is that if you are a very high skill or individual, or you have a very unique talent, or it's a kind of talent that, again, allows you to be something like a professional athlete that the president mentioned, whatever the case may be. It doesn't have to be necessarily intellectual. It could be physical. Doesn't matter. Whatever the case, there are plenty of people who are willing to pay that, I think, because it would still be a net benefit. The other thing is that this also, I guess, indirectly points to the program likely being a success. It's essentially the complete opposite of what we have been doing for the last 4 years. So the last 4 years, we have not been trying to import the best and the brightest. We have not been trying to import, the smartest and the most productive. We have not been trying to import the most credentialed people, the most talented people, et cetera. What have we done? We've been importing criminals. We've been importing people who essentially have little to no skill sets. Yeah. And what has the result been? They directly compete with Americans who have little to no skills. Guess what? That's all of us when we first start our careers. That's all of us when we're, like, let's say, teenagers, or even for some people in their 20s, and they're trying to get their first job. Or maybe even their second job, whatever the case may be. So it is essentially making it impossible for a lot of young Americans to get that first job, which is the first rung on the ladder of success. You can't get the second job usually if you don't have the first job. And as a result, it has caused a lot of Americans, especially young Americans, to get onto welfare, to live off the dole. It's caused a lot of them who have no business going to higher education to go to higher education. And look, higher education is not for everybody. I can speak to this about a member of my family, actually, who instead of going to higher education, because he never liked school, never did well, it was never for him, he ended up learning a trade. He does incredibly well for himself. I mean, incredibly well. Has a beautiful home with him and his beautiful wife, and there, let's see, 1, 2, 3, 4 children now. Again, does very, very well for himself because he works his tail off in a trade, and he didn't graduate a 4-year with a 4-year degree and essentially $250,000 of student loan debt.
Yeah.
He didn't do that. In fact, a company paid for him to learn his trade because they're so hungry for skilled workers. So, but again, not having the ability, let's say, to get his first job or his second job even would have made all of that impossible. And so it has for a lot of Americans. And so again, what has caused such deleterious effects on our economy and on our young people and on our workforce, on native-born Americans, has been this mass importation of low skill or unskilled labor. So much so, Anthony, that there are actually fewer native-born Americans working today than there were 5 years ago before the pandemic. So literally, think of that. All the job growth we have seen, all the job growth that Biden and the Democrats have been bragging about for the last 4 years,
Yeah.
it's all been foreign-born workers.
And 60% of it funded directly or indirectly by the government, by increasing debt. And
Exactly. Yes.
So it's really been a debacle. I think the one thing, there's two things about that. That's a great explanation of it. The first thing that I pick up on is how complicated the whole system is and how disruptive an open southern border is. Without having that sovereign border, you've destroyed our system of safety. You've destroyed our economic system. You've destroyed our social system. You've literally started to break down everything, every construct within the United States of America to the detriment of its citizens. And I think it's a disgrace that the Biden administration and the Dems continue to pound the table and want that to be the norm. I think it's gross. The second thing that I pick up on is you mentioned your family member who has 4 kids. And in my head, I said to myself, wow, that's sick. That guy's got 4 kids. They must be really busy. And then I remembered, oh yeah, I have 4 kids. So that was the second thing that I picked up on. I want to move on because there's been a lot of vocal kind of challenges to this and critics of the gold card for different, pathetic social and soapbox reasons. But one, Sonny Hostin of The View. I don't watch The View. I know that's shocking.
I don't think anybody watches.
Huge Whoopi fan. But I want to, the name of this next segment, and I have it tagged for our producer, is How Dumb is Sonny? And I'm actually thinking about making this a weekly thing where we just pick one. I've gone through so many of our comments, and I honestly was sitting at my desk saying to myself, how dumb is this lady? So how dumb is Sonny? Can we please see this week's clip of how dumb is Sonny? It might not have to do with the gold card.
It angers me when people are like, this woke stuff, it's got to go. That's telling me that you don't care about my lived experience. You don't care about the oppression of the LGBTQ community. You don't care about the oppression of the disabled. You don't care about the oppression of immigrants. You don't care about your fellow neighbor. And that is ungodly. That is not Christian. So.
Well, yeah, but you know what the most ironic thing is? They don't care about it, and they don't care about it while wearing big fat crosses around their necks.
Yes.
Well.
Yes.
Wait, I gotta step in here. Sonny, about your lived experience, you're doing better than over 99% of the country. You're not oppressed. And no one is oppressing the disabled. They are oppressed by their disability. And with LGBT, well, taking over every corporation, running the culture with an entire month in your name, and turning every criticism into a hate crime is not exactly oppression. It's called a privilege that others do not have. And with immigrants, I'm an immigrant. I am not oppressed, Sonny. I have the same opportunities as everyone else. And I'm absolutely offended by condescending liberals like you telling me that I am a victim and that I'm oppressed. And all of this cuts right into the core of your wokeness, trading righteousness and virtue signaling to look good while shutting down everyone who doesn't bow to your narrative, like calling Christians ungodly for not being woke. By the way, try saying that to Muslims who are not woke either, and you will quickly realize just how kind Christians have been to you.
I don't know who this guy Damon is, but if he could stop just superimposing himself on The View and actually have them take him on as a guest, I would love to hear the real conversation, because I think that they would be as dumbfounded as they were in real life.
I mean, look, I wish so too. Obviously, they'll never have him on because they would never want their worldview challenged. And I think the crickets from that video, I think they are, yes, Sunny's dumb, but she's at least not so dumb to realize that that's not exactly what would happen in real life. In other words, if they have him on, she knows I wouldn't have a response. There is nothing I could do. So yeah, I would just have to sit there and look like even more of a moron than I already am.
Insane. I know we talk a lot about debt and deficit. I know we pushed the time limit this week, but I found one more thing that I thought was hysterical. This is you and I looked at it before. This is kind of our interpretation of how the Democrats spend our taxpayer dollars, and then we're going to wrap it up.
Hello?
Honey? Are you at the club?
Yes.
I'm at the mall now, and I found this beautiful leather coat. It's only $1,000. Can I get it?
Well, sure, if you like it that much.
Okay. I also stopped by the Mercedes dealership and saw the new model. You know, the one I really like.
How much?
120.
Well, at that price, I want it with all the options.
Great. Oh, and one more thing. The house we wanted last year is back on the market. They're asking 1.5.
We'll make them an offer. But come in at 1.4.
Okay. I love you, baby.
I love you too.
Okay, bye.
Does anybody know whose phone this is?
Too funny. They're really good at spending everybody else's money. They're really good at taking it back and kickbacks and working for $200,000 a year and being worth $50 million. I still haven't figured that one out. If they could write a book, somebody could write a white paper on it and explain how to do that, I'm all in. But yeah, that's kind of the view of how the Dems spend our money. So I'll kick it to you for the end.
Some of the
BJ.
Republicans too, right? You got Dan Crenshaw up there, who he's actually, I think he's number 2 behind Nancy Pelosi in terms of that the people who follow members of Congress and say, okay, these are their rates of return and everything. And Nancy Pelosi always like blows the market out of the water.
Yeah.
Somehow the market has a down year and she's up like 400%. Crenshaw is actually, I think, right behind her.
Really?
He was the one who infamously in the one interview when someone said, like, don't you think we should stop members of Congress from owning stock? And he literally says, how are we supposed to make our money? Right? What do you want us to work for free? Come on, we haven't had a cost of living increase in years. You guys, what about the American people? We haven't had a cost of living increase either. We've been going in the other direction.
Yeah, absolutely insane. EJ, a pleasure. It was a long one, but I think it was a good one. And I actually really appreciate going into the market first because there's a lot going on. On the day today, we're up small, but I think we may see a little bit. We will see volatility. We may see, a nice 1-3% rally from here, but we're going lower. So I appreciate looking at that first. I appreciate the commentary on the economic numbers and on the gold card. Your view is always appreciated and spot on. And I will talk to you next week.
Till then, Anthony, always a pleasure.
Thank you.